Hi, in this video I'm going to show you a free cash flow. What is free cash flow? Now before I work out the free cash flow and explain it, I would like to remind you that you must have calculated cash and cash equivalent in cash flow statements. Now that cash flow statement is part of statutory accounts and they are prepared using the IFRS, and calculating cash and cash equivalent is useful for any stakeholder who would like to see the liquidity of the company, especially a bank who is going to pay loan to a company. They would like to see if the company has got enough liquidity to pay back the loan. But as an investor, as an analyst, we look at cash flow statement in a different way. We need to find out the free cash flow. That is a cash flow available for equity investors because they would like to earn dividend. So now let's imagine company is a cash processing machine. It will generate revenue, and the revenue will bring in cash. It will generate cash. And that cash will be used to pay for the operating expenses. So the firm will pay for the operating expenses, such as paying for expenses. Any leftover cash will be used to pay for the long-term investments, and that long-term investment is referred as plant, property, and equipment. And the firm will also pay for the short-term investments. And these short-term investments are like inventory and receivables, and they are usually called working capital. Working capital. Any leftover cash will then be used to pay the lenders, the bond payments, because they have priority over the equity investors. So the bond payments will be made, and those payments are in the form of interest and principal. After paying the bond investors, the debt financing, so that is debt financing, this is fixed asset needs, and these are working capital needs. So after paying for the long-term investments, short-term investments, and for the debt financing, whatever is left over is called the free cash flow to equity. Which is FCFE. And this is left for investors. the directors will have to make a choice. They can pay dividend to shareholders. They can use that free cash flow to buy back the shares. So I'm going to make a note here. They can either return to shareholders, return cash to shareholders in the form of dividends or share buyback, or they can decide not to give all that money to the investors but to reinvest cash in the company. In the form of internal growth, acquisition, or simply save the cash. So, as a potential investor, how can they use free cash flow for the valuation of the company? Well, they can use free cash flow and calculate the discounted cash flow. So this free cash flow can be used in the calculation of discounted cash flow. So free cash flow time 1, free cash flow time 2, free cash flow time 3, and so on, and free cash flow time T. So we can work back the discounted cash flow to year 0, and that can be used for the valuation of the company. So the formula which is used to calculate the free cash flow is equals to cash from operations well, this figure, which is CFO, cash from operations, this figure can be obtained from the cash flow statement. So once we have the cash flow from operations, we will subtract the capital expenditure, which is referred as CAPEX. So this formula will roughly give you the good estimate of free cash flow. I hope this video will be useful. Thank you.